Looking at Sasol, came out with a trading update. Headline earnings per share expected to be down by at least 45%. Was it pretty much in line with expectations?
Yeah, definitely. I mean, we've changed our view on Sasol quite a while ago. We had it as a portfolio buy. We've changed our view more of a trading stock. So what that means is that if we do have quite a few in the portfolio and the stock does increase to about 300 to 315, we would sell, and with a decrease to about 260 or 250, we would actually buy. So we're not actually holding the stock in any investment capacity at the moment. At least that's the general view currently. I know a lot of people love Sasol, the name, sort of one of these old things that they have in their portfolios, but you know, things need to change as well. So we're very disappointed actually with Sasol, because it is a fantastic business. I mean, there's nothing essentially wrong with it, but you know, there's been a few issues in the past that have managed to change our view. So what's happened recently?
About the competition commission issues.
Yeah, look, I mean, there's a competition commission. I mean, it's really unacceptable, quite frankly. And then, what's his name? Dr. Benny Makaba. He left, actually. He was the head of synthetic fuels, which wasn't doing very well at all for the business. So it'll be interesting to see who's going to fill that role. So it's a tale of two cities. Parts of the business are doing very well, other parts are not. And then you've got the problem with the rand, dollar, and obviously the oil price as well. So they are suffering. It's just not an area I would be in at the moment. So I would say if you've got tons of Sasol in your portfolio, it goes to 315. It's a great sell. If it pulls down to 250, 260, it's a great buy.
Others would argue with that and say that it's a good way to have exposure to oil, and we know oil prices are going to be heading upwards because the global economy is on a path to a sustainable recovery.
Correct.
And when you look at that, obviously that should counteract any strength that we see coming through on the rand.
But remember, Sasol's not just a pure oil business. There's so much more to it than that.
Coal to liquid plants.
Yeah, synthetic fuels, chemicals, so on and so forth. There's a lot of inputs that have to go in there. You know, if you wanted to buy not a pure oil company, but if you wanted to take another choice, buy Billiton at the end of the day. You know, I mean, 30% of Billiton's EPS is now oil-based, which is massive, you know. So my view is if I don't have Sasol in the portfolio, my oil exposure from a South African perspective is BHP Billiton. So I'd rather go heavier in Billiton and have no Sasol in the portfolio than have both at the moment. So that'll be my strategy currently.
Nicholas, what about all of these gold companies? Because they are rallying on the back of that gold price, steaming ahead, and we saw it hit $1,226 an ounce, slightly softer at this stage of the trading day. But again, the rand issue versus a very strong underlying commodity price.
I think it comes down to the point that gold companies are not good investment vehicles at the moment. They're good trading tools. Plain and simple, South African gold companies. I would not be buying them for an investment in a portfolio. I would buy them for a trading position, a short-term move, because they are incredibly volatile and they're beautiful to trade with. If I want to invest in gold, I'll buy physical gold, new gold ETF. That's the only one you need at the end of the day. Why wouldn't I invest in gold in South Africa? Well, we've got the rand issue. We've got electricity price tariffs, which is going to kill any margin the gold companies are making at the moment. And our industry, our gold industry is very old. It's very deep mines. There's not a hell of a lot of stockpiles left. You know, we've basically mined everything at the moment. So I think a forward-looking view, I would not invest in gold. If I wanted to trade, Harmony is a great one because it's very highly geared and it is a pretty decent company. The little guys like DRD and Simmers and so on, that's way too speculative for me, and I wouldn't look at them.
JSE all share under pressure today, but generally we've been doing very well. We've gained significant ground for 2009 when you take a look at where we were in March this year. You mentioned three key elements a little earlier in the show about your concerns. You mentioned job creation, electricity tariffs, and of course the political scenario and what will be playing out there. Let's focus on the electricity tariffs because that's the real interesting one, and it's impacting businesses all round, and this is obviously going to hamper the bottom line at the end of the day. Are you staying away from the companies that are very reliant on electricity?
Well, not yet. I mean, it's also very difficult to ascertain what kind of impact it would be, you know, because it's something that's very new and it's something that hasn't come on stream in its totality yet. And don't forget that if I'm a big producer of iron ore in South Africa, I'm going to get a much better deal than the average homeowner as well. It'll be interesting to see how South African companies react to it to try and get their costs under control, and a lot of them are doing something about it now. So it's not like, you know, electricity price tariffs are going to go up. We must steer clear of all companies. I'd certainly be concerned about the mining industry specifically. So, you know, I wouldn't steer clear of local mines, but I'd try and put some of my money in more international mines. We get back to Billiton again because it's one of the most obvious ones. It's very, I think it's just got an aluminium smelt in South Africa, and that's about it really. You know, but complete local mines such as maybe Anglo's Kumba and Exoric could get a bit of heartache from that electricity.
We saw
price
Sasol down 2.2% today, Anglo Gold down 2%. Discovery, on the other hand, up 4.5%. And we know Discovery bought about 25% in Ping An. And of course, that's a Chinese insurer. Would you be going for a defensive company like this? I
guess these are the things to look at as well. I mean, I wouldn't say I'm not a huge fan of Discovery. I just don't really know the business as well as I guess I should. It's not something that I have on my portfolios. If I'm going defensive, at the moment, I'm going British American Tobacco and Netcare currently. I've never been a firm favourite of insurance business, health insurance or financial insurance. I just steer clear of them. It's just a personal feeling. So I know a couple of my colleagues look at Discovery and it's done incredibly well. It's just always worrying about that share price. It just keeps on going up. So it's very difficult for me to buy something at all-time highs or near all-time highs at the moment.
Right, South African life insurer Liberty Holdings has agreed to buy 57% of Kenya's CFC Insurance Holdings as part of a drive to grow its presence in East Africa. CFC Insurance provides insurance services in Kenya and Tanzania. Liberty is controlled by Standard Bank, and the transaction is part of the lender's restructuring of its East African business. It will see the life business separately listed on the Nairobi Stock Exchange by next June. It will also see Liberty inject 880 million shillings for a 24% stake in CFC Insurance. The four-step transaction requires approval by both Kenyan and South African regulatory authorities. Godfrey Mutizwa earlier spoke to Rex Tomlinson, Deputy CEO of Liberty Holdings.
Now, in this transaction, of course, you're piggybacking off Standard Bank's presence, and it's a continuation of a process I think that you guys have spoken about before. But some analysts are also seeing this a possibility, perhaps, that you could be relooking at your strategy inside South Africa in a similar fashion. In other words, you're taking care of the insurance businesses and Standard Bank concentrating on the banking side of the business.
Well, if de facto, by and large, that's largely how it works already. We're a listed subsidiary of the Standard Bank Group, and the collaboration at a strategic level and operational level is very, very close. And we certainly see it as a massive advantage, strategic advantage that we have as Liberty, having a partner like Standard Bank, and clearly part of our strategy is to follow their footprint into the rest of Africa. The difference in South Africa being is that they have the short-term business. But that doesn't mean that there's not collaboration around opportunities in the short-term business. And I'm not necessarily sure that you need to have an ownership structure change to get the benefits of that.
Indeed. So we're talking about East Africa. What about West Africa? Are we likely to see perhaps a continuation of this same strategy going forward?
Yeah, we've always said that the other major node that I think if you want to be a player of any meaning and size on the African continent, you need to play in that West African region. And we've chosen and been open about saying that Nigeria would be our point of entry. Once again, we have the opportunity to leverage in with the Standard Bank's presence in the country. We took our first step there by buying a stake in a small health business called THT Health, where we will, over the next 2 years, obtain majority. It's small. It was a first step, and it was part of our health strategy, because that's obviously a large market in Lagos area. And yeah, there's a whole lot of work being done now around finding the most opportune entry point into that market.
Nicholas, how are you positioning your portfolio now that we're ending 2009? 2010 is supposed to be a better year, and of course, notwithstanding all the debt woes that have emerged from Dubai and of course Europe. That's
actually an excellent question, and it's a good point as well. I think going forward, a lot of strategists and a lot of people I've been speaking to and things I've been reading will still see the markets moving forward, at least for the next 6 to 9 months. And basically that's due to what's happening with interest rates in America and parts of Europe. They're still very, very low at the moment. There's a lot of carry trade coming over, and that's pushing up a lot of our resource stocks. So I'd still be heavy resource stocks because I still believe they are going to go up, no matter how artificial the increases have been. Okay. What I am doing is I am starting to make part of my portfolios more defensive. All right. So I'm not completely cognizant about what's happening at the moment. I think it's important to go a little bit more defensive now, because it's very easy. This market can go up another 5%, but it can drop another 20% as well. So what I'm saying is have a good exposure to your volatile resources. I still think they're going to go up, but start bringing a bit of defensiveness into the portfolio. Favorite stocks at the moment would probably be a British American Tobacco. A Rainnet is quite nice. City Lodge would be a good one to look at. Netcare would be one I would consider picking up, and maybe a few industrials as well. We could see some of these cyclicals moving up again, so potentially a few PPCs and Barlow Worlds and so on. That's what I would be.
Thank you very much.